Perfect. So, guys, we will now be beginning. All right. Thank you. Second. All right. Hello, everybody. My name's Justin, Business Development Manager here at Fullerton Markets, bringing to you a special class on trading indices. All right. Now, I'm sure some of you have traded Forex before, and I'm sure that you guys have seen, these indices and you've probably read about them online, but you have always wondered, what are they? All right. How are they different from Forex? And is it something that I can trade? Well, very fortunately, here at Fullerton Markets, we have a wide plethora of tradable instruments, all right? Among them, we do have indices. So I hope that you guys can learn some tips and tricks from me later on, all right? So without further ado, let us begin. All right, so what are indices? All right, basically they are a basket of selected stocks. All right, so if you've ever bought a gift basket before, a fruit basket from your local supermarket, you might find that's already wrapped up, and inside the basket you would find a whole lot of fruits. You might have a watermelon, you might have grapes, apples, peaches, oranges, and they're all bundled up together and they come with a price tag. All right, they come with a price tag. Same thing with indices, all right? Same thing with indices. Now let's take a look at the first one written here. Now it says DJIA, which stands for the Dow Jones Industrial Average, all right? So some of the companies we can find here are Apple, Microsoft, Boeing, Visa, and Walmart, all right? These are the things we can find in the Dow Jones. There are many more. There are roughly 30 of them, but these are some of the most well-known, okay? Afterwards, we have the DAX, which stands for the Deutscher Aktien Index. This is in Germany, all right? So we have Bayer, Deutsche Bank, Siemens, Volkswagen Group. Afterwards, we have the Nikkei for Japanese stocks, all right? There's Canon, Casio, there's Honda, Mazda, and all of those other automobile manufacturers from Japan, okay? So keep these three in mind because we will be talking a lot about them later on. Let's move on. So CFDs can be found on your MT4, okay? They can be found on your MT4. Now, here's something I would like to share with you guys as you are beloved clients of Fullerton Markets. Now, since there are so many different types of clients and so many different account sizes, meaning the amount of funds you have in your account, not everybody can afford trading indices, all right? Thankfully, we have provided something known as mini indices, all right? Mini indices in Fullerton Markets is exactly the same in price as the regular indices, except the lot sizing is different. All right. So if you can see here, the first one, which is the Dow, the price is 28192.55. And for the mini, which is located down below, it is still the same price. Okay. The only difference in the symbol is there is a small letter M indicating mini. Okay. So you guys can go ahead and look this up on your MT4s. Later on, I will show you how you can access them. Okay. Let us move on. Here are some key differences between trading CFDs and Forex. All right. So if you were to trade in the Forex market, one standard lot is a contract size of 100,000, while trading CFDs is only 1 or 10. It depends on the index you are trading. All right. The minimum lot on Forex is 0.01. This is the lowest that you can go. All right. For indices, it is 0.1. All right. However, the maximum lot for indices is at 250 per trade, my friends. If your account can handle 250 lot trades, that's fine. All right. But per trade, the maximum lot that you can take is 250. And on Forex, it is 100 lots. All right. Now, the leverage, it still depends on the account type. Okay. Now, if you see here, the last one, it says 3 times swap. What is 3 times swap? Well, basically, when you trade Forex, right? When you open a position, you'll notice that swap occurs after a period of time. All right. Once it resets on the server around, let's say, midnight, you can see swap will be charged to your account. It could either be positive or negative. Okay. However, here, uh, here on the indices, it is different from the forex swap, where they actually charge when they actually do the 3-time swap. For indices, it's on Friday, while on forex, it is on every Wednesday. All right. So if you guys are planning to hold trades that will pass by Wednesday or Friday, make sure that you are, more than ready for the swap. Okay. Keep those in your calculations. All right. Because you can also close your trade just before Friday or just before Wednesday, so you don't get hit with the 3-time swap. This is for the the other days that, let's say the weekend, that may have not been counted for swap. All right. So let us move on. All right, here at Fullerton Markets, we have created a list so that you guys can see the contract size per in for each of the indices that we carry. All right, the units of CFDs contracts that made up a standard lot on Fullerton Markets. All right, for example, one lot on the Nikkei, or the Japan 225, is actually made up of 10 units of Nikkei contracts. All right, so this is all available on our website. All right, feel free to have a look. All right, so let us move on. Please excuse my voice, it is a bit hoarse. I'd like to apologize for that, but we must continue. All right, let's move on. There are 4 factors that affect index price. All right, monetary policy, economy, geopolitical events, and investor sentiment. All right, we have tackled these at another video. However, they still ring true here when you trade indices. Now, let me give you guys a few examples. All right, here for monetary policies, let me just read it out to you. Bank of England poised to announce more stimulus as stock market rally fades. All right, monetary policies are created by the by the central banks within a country, an economy, or a zone. For example, we have the Federal Reserve in the US and we have the Bank of England in the UK. All right. So when they come up with monetary policies, it will affect businesses, and ultimately, when businesses are affected, the index itself will be affected because it is made up of all of these companies. All right. Next, we have economy. Here it says that the Dow rises as retail sales rebound, suggests economic recovery underway. All right. Dow rises as retail sales rebound, suggests that the economy is recovering. All right. Excuse me. The economy is recovering. The economy is recovering. Businesses are doing better, and inevitably, some of these businesses that are doing better will affect the price of Dow, and the value will increase. All right. One moment. Geopolitical events. All right. S&P 500 jumps to record as US and China get set to finalize phase 1. Now, what are geopolitical events? Now, these are the these are the events that one country has with another country. All right. The trade war between China and US is a very good geopolitical event. At the same time, if war to break out between 2 countries, that is also a geopolitical event. All right. Other things such as calamities, natural disasters, and yes, even what we're going through right now is part of geopolitical events. Once again, I'm sorry for my voice. Let us move on. All right. Investor sentiment, or in other words, how traders feel about the market. All right. Global stocks retreat as investors fret over coronavirus relapse. All right. Now, the global trading scene, they're reading news, they're monitoring countries, they're monitoring the coronavirus, and if it deems that there might be a relapse, they may start trading elsewhere. All right, they might start investing in safe haven currencies and all of this, which will inevitably affect indices. Ladies and gentlemen, I'm so sorry for my hoarse voice. Okay. I will just try to slow down so you guys can better understand. Let us move on. So I will be sharing with you 3 tips to trade indices profitably. Okay? Now, the first tip has to do with the Dow, the Nikkei, and the DAX. All right? Now, all 3 go in the same direction. All right? Since the US economy is closely related with, with the Eurozone and Japan, they affect one another. And if one of these go in a certain direction, the other 2 will follow. All right? So if the Dow is going up, the Nikkei and the DAX will also go up. Now, if it's going down, if any of the 3 is going down, they will also go down at the same time. I will be sharing with you some examples later, okay? All right. So go ahead and write this down. Feel free, take a minute or 2 to write it down. Okay. So I hope you guys have written it down or have, typed them down on your phones. All right, let's move on. So remember, guys, one of them goes up, the other 2 will go up. One of them goes down, the other 2 will go down. All right, let me give you guys an example. All right. It says here that the Dow Jones, the DAX index, and the Nikkei 225 extend rally. All right. As you can see, all 3 of them were mentioned in the same subject, and that all 3 of them extended their rally, meaning they are all connected. One goes up, the other 2 will go up as well. Okay. That is the first tip that you guys can take when it comes to trading indices. All right. Now, the second tip has to do with the Nikkei and the Japanese yen. All right. Now, to give you guys an idea, the Nikkei is inversely correlated with the Japanese yen, right? They are inversely correlated. So when one goes up, the other goes down. But you might be wondering, why is it that here it says that if USD JPY goes up, the Nikkei also goes up? Think about it. Well, it has to do with where the JPY is located on this currency pair. It says USD JPY, meaning if the USD goes up, the Japanese yen will go down. Okay? All right? If you're looking at the USD JPY, if it's going up, it means USD is getting stronger and the Japanese yen is going down. That is why that if USD JPY is going up, Nikkei will also go up, because the Nikkei and the Japanese yen are inversely related. Okay? So if, for example, the Japanese yen is strengthening, all right? If you look at that on USD JPY, you will see that it is going down, all right? Now, if it is going down, the Nikkei will also go down. Understand? Okay? That is how I would like to put it. But of course, you can always remember that USD JPY goes up, Nikkei goes up, USD JPY goes down, Nikkei also goes down. Okay? Now, the next question is, why is this so? Why is the Nikkei inversely correlated with the Japanese yen? Well, it's, excuse me, one of the primary reasons has to do with exports, okay? If the yen is going down, all right, the yen is going down, exports will start picking up in Japan. And since a lot of for example, let's take the automobile manufacturers in Japan, a lot of their revenue comes from exporting cars to other parts of the world, all right? If the yen goes down, you can now buy these cars much cheaper than local competition, which would lead you to generate revenue for these automobile companies, which will provide an uptick in the Nikkei. All right? All right? Now, if the Japanese yen is strengthening, exports will go down, things become more expensive for exporters, all right? Which will be bad for the Nikkei. All right? So this is the logic behind this tip or this principle. So I'll give you guys another minute to write this down. Okay. All right. Let me give you guys another example. All right. Japan's Nikkei gains as yen retreats. All right. Tech shares stumble. Now, just from the headline, we can immediately see the relationship between the Nikkei and the yen. All right. The Nikkei went up because the Japanese yen went down. Simple. All right. Keep that in mind when you are trading. All right. And the third tip that I will be sharing with you guys is, hold on, let's just do this one again. Nikkei 225 has recovered, winning streak. Yen falls on Abe victory. Same thing. The Nikkei has record winnings while the yen is tumbling. Okay? This is tip number 2, once again, in action. All right? So let me share with you the third tip. All right? The third tip is known as the VIX index or the CBOE volatility index. Now, what does CBOE mean? All right? CBOE stands for the Chicago Board Options Exchange. All right? They have come up with a volatility index, otherwise known as the fear index. All right? Fear index. All right, so guys, write this down. If the VIX or the fear index is greater than 40, the stock markets will tumble. Okay? If the VIX is greater than 40, stock markets will tumble. Now, if the VIX is less than 20, the stock markets will appreciate. All right? You might be wondering why. Well, the volatility index, it measures fear or sentiments within, it measures the sentiments within whatever it is you're trading. All right? So this gives you some sort of peek into the mindset of of a majority of the players in the market. All right? So greater than 40, start selling. Less than 20, start buying. All right? Easy. Let me give you guys an example. All right. VIX daily update, volatility slides as stocks resume uptrend. All right. There are volatility dipped, hence the uptrend of stocks. All right. The second one says that the CBOE VIX volatility index declined slightly on Tuesday, which led to the S&P 500 rising. So that is once again tip number 3 in action. So, ladies and gentlemen, that is it for me. My name is Justin, Business Development Manager here at Fullerton Markets. I hope you guys enjoyed our class, and I look forward to seeing you all in our other classes. Thank you all, and goodbye.